Welcome, my friends. Forget every book that promises a holy grail system and every illusion about a 90% win rate. I have spent 2 decades grinding through the trading floor, witnessing every financial earthquake, from the dot-com bubble and the 2008 housing collapse to the brutal COVID-19 meltdown. 20 years didn't just teach me how to read charts. They taught me how to read fear and greed in people. And if there is one truth that has stood the test of time, it is this. Trading is not a game of being right often. It is a game of winning big when you are right and losing small when you are wrong. Let's be honest. How many of you have had 7 winning trades in a row, felt like a genius, only to see one single loss wipe out your entire week of profits? That feeling cuts deep. You sit there, watching the chart reverse, the red numbers climbing, and one thought echoes in your head. Why me? The answer, as harsh as it sounds, is brutally simple. You are playing the wrong game. Most traders fail not because they lack technical knowledge, but because they misunderstand the nature of the game itself. They think trading is about winning percentages. The more you're right, the faster you get rich. But the market doesn't reward that logic. The market is a machine designed to crush egos and only rewards those who manage risk like survivors, not dreamers. Across the thousands of trades I have executed, from buying Apple stock when it was undervalued to betting on the Japanese yen during turbulent times, I discovered one unbreakable rule. The Pareto principle, or the 80-20 rule, applies perfectly to your trading account. Let me make it clear, 90% of your net profits will come from just 10 to 20% of your best trades in a year. Those rare moments when you catch a major trend or hold your position long enough for profits to run. The remaining 80% of the time, you will merely grind sideways, collect crumbs, or take small losses. And it's exactly here where most traders destroy themselves. They cannot stand small losses. They treat every losing trade as a stain, a humiliation. They hold on, hoping the market will turn back in their favor, and that small loss quietly grows into a ticking time bomb. Eventually, one big loss is enough to erase an entire month of hard work. Look at Jim Simons, founder of Renaissance Technologies, a mathematical genius who turned the market into his laboratory. His fund's win rate is only around 55%, yet his annual returns consistently crush the market. How is that possible? The secret lies in risk control and position sizing. When they are right, they win big. When they are wrong, they lose tiny. It is a game of probabilities, not pride. Warren Buffett once said, "Rule number 1, never lose money. Rule number 2, never forget rule number 1." It sounds simple, but to live by that rule, you need iron discipline and a mind colder than steel. Remember this, one great trade can make up for 10 mediocre ones, but one uncontrolled loss can destroy 10 months of profits. The winner is not the one who is right most often. It's the one who protects capital the best. I still remember the chaos of 2008 when Lehman Brothers collapsed. Phones across Wall Street were ringing nonstop. Everything was on fire. I was holding several financial stocks at that time. Overnight, my account dropped 10%. My heart pounded. Sweat drenched my shirt. I stood before two choices: hold and hope, or cut immediately. I chose to cut. That decision cost me $10,000. A month later, those same stocks fell another 40%. If I hadn't been disciplined, I would have gone broke. That small loss was the insurance premium I paid for survival, the price that allowed me to stay in the game. Because I survived, I caught the massive rebound in early 2009 that brought in over $100,000 in profit. You see, trading is not about how many times you are right. It is about staying alive long enough to catch the big move. Imagine you are a hunter. You cannot hit every target, but one clean shot at a big deer can feed you for a month. The missed bullets? They are just the cost of hunting. Trading works the same way. Every small loss is a bullet you're willing to fire to get a chance at your big deer. The problem is, most traders are afraid to pull the trigger. They fear being wrong. They fear being humiliated by the market. They fear finding out they're not as smart as they thought. But that fear is what kills discipline. Once emotions take over, you stop being a trader. You become a gambler praying for luck. Remember this, a small loss is your ally. It's the armor that shields you from disaster. Every time you cut a loss early, you are buying yourself another ticket to stay in the game, waiting for that 80-20 moment. That rare window when the market opens the door for you once, and if you have enough capital and a clear head, you can step through and change your entire year. Most retail traders don't lose because they can't read charts. They lose because their psychology rebels against probability. They crave high win rates, so they take profits too early out of fear. But when a losing trade comes, they freeze, refusing to cut, afraid of losing. The result? Small wins, big losses, and an account that only moves one way, down. I once had a student named David. His win rate was 70%, impressive at first glance. But when I reviewed his trading journal, I saw that every losing trade was 5 times larger than his winners. After 3 months, his account was still negative. I forced him to change his strategy, aim to be right only 2 out of 10 times, but make each win count. 6 months later, David's account was up 30%. Not because he was right more often, but because he lost less when wrong. Do you know what every legendary trader has in common? George Soros, Paul Tudor Jones, Stanley Druckenmiller. They all say the same thing. It's not about being right or wrong. It's about how much you make when you're right and how much you lose when you're wrong. I've seen hundreds of talented traders go down, not because they couldn't analyze charts, but because they didn't know when to stop. They wanted revenge on the market. They took every loss personally and doubled their positions in anger, only to be crushed again. The survivors? They accept losses like warriors retreating to conserve strength for a bigger battle. They see every small loss as a brick in the fortress protecting their capital. If you want to break free from the cycle of failure, carve this formula into your mind. Risk 1 to make 3. You risk $100, aiming for at least $300 in reward. Even if you're right only 3 times out of 10, you still come out ahead. That's the magic of RR, risk-reward. That's why major funds don't obsess over win rates. They obsess over the risk-reward ratio. Every small loss you take is a fee you pay for your next opportunity. And if just one of those 10 opportunities turns into a long-running trend, the entire game flips in your favor. That is the art of survival. After 20 years, I've learned this. Trading isn't a game for the smartest. It's a game for the most disciplined. The market doesn't need you to be a genius. It just needs you to be humble enough to know you can be wrong and resilient enough to survive being wrong. Once you accept that losses are inevitable, you begin to trade like a professional. You stop trying to win every small battle and focus instead on winning the war. One day, when you look back, you'll realize every small loss wasn't a failure. It was the tuition you paid to become the last trader standing. If you're holding on to losing trades, exhausted from chasing a high win rate, remember this. You don't need to be right 8 times out of 10. You only need to be right twice, but win big. That paradox, that beautiful madness, is what saves your account, and maybe your entire trading career. All of us claim to understand the concept of cutting losses, yet very few truly survive the first real test the market throws at them. As the red numbers grow larger and every dollar slowly bleeds from your account, your heart begins to pound, your palms start to sweat, and that familiar voice in your head whispers, "It's going to come back." That voice has killed more talented traders than any market crash ever could. Not because they lacked knowledge, but because they refused to accept small losses. They would rather sink with a losing trade than admit they were wrong. The tragedy is they never realize that accepting being wrong early is the ultimate survival instinct of a true Wall Street player. When I was working in a Manhattan trading room for a fund, I witnessed a man lose his entire career simply because he couldn't press the close button. He held a massive long position on the euro when the European Central Bank unexpectedly changed its policy. The trade turned against him within minutes, and instead of cutting his loss as the rules dictated, he tried to average down. 5 minutes later, the loss tripled his allowed risk limit. 10 minutes later, his entire margin account was gone. When I walked over, he just looked at me and said something I will never forget. "I just wanted it to come back to break even." That sentence is the death warrant of most losing traders. They don't want to win, they just don't want to lose. But on Wall Street, if you don't know how to lose properly, you will never win. Cutting losses is not the act of the weak. It is the highest expression of discipline. Every time you take a loss, you send a clear message to the market: I am not controlled by emotion. That is why professionals can survive decades while the crowd gets wiped out within months. A mentor once told me, if a trade keeps you up at night, your position size is too big. It sounds simple, but that one sentence became the compass for my entire trading career. To escape the mindset of holding losses, you must change how you view losing. See it as a necessary business expense, not a personal failure. A company can spend millions developing a new product, and if it fails, it's still considered a cost of doing business. Traders are no different. Each loss is an invoice sent to you by the market, reminding you that you're running an investment business. You are paying for information, for experience, for a deeper understanding of price behavior. But most traders don't get this. They see a loss as an insult to their ego, as proof that they're not good enough, and that very thought makes them pray. To make this clear, imagine two traders entering the same market. The first uses a tight stop, risks 1% per trade, and loses 10 small trades in a row, but still has 90% of his capital. The second keeps holding, hoping the market turns, and after just 3 losing trades, half his account is gone. Who has a better chance to recover? On Wall Street, we call the first type the survivor, and the second the soon-to-be history. The only difference between them is a single mouse click: the decision to cut losses. Once you learn to accept small losses, you unlock the door to big wins. Most traders don't fail because they lack good strategies. They fail because they never let their winning trades grow. They take profits too early, terrified of losing what they've just gained. They crave immediate certainty. But in the market, certainty is the most expensive illusion you can buy. Professional traders understand that one big win can pay for an entire string of small losses. That's why they are patient. They let the market do the work. They use trailing stops like a smart safety net, one that protects profits while letting the price keep moving in their favor. For example, when I enter a long trade on gold with a $200 stop loss, I set a $600 profit target, a 1-to-3 risk-reward ratio. But if the price keeps moving my way, I don't close the trade immediately. Instead, I trail my stop upward following the price structure. When the trade is $600 in profit, my stop may already be at break-even or higher. If the market reverses, I lose nothing. But if it continues trending, I let it run. Some trades like that have made $2,000 or even $3,000 simply because I didn't cut profits too soon. The challenge isn't technical, it's psychological, having the courage to let profits grow without fearing they'll vanish. I've seen countless traders trapped in the obsession of wanting to be right instead of wanting to make money. They chase a high win rate and the fleeting rush of victory. But on Wall Street, real winners are those who make more when they're right and lose less when they're wrong. A trader can be right only 3 times out of 10, but if each win is 4 or 5 times larger than the risk, he still ends up far ahead. Meanwhile, someone who wins 8 times but takes one massive loss can still go broke. The market doesn't pay for accuracy, it pays for discipline. That's why every decision to cut a loss must become instinctive. No hesitation, no debate. The moment you find yourself needing to justify why you're still holding a losing position, that's the signal emotion has taken over. In a professional trading room, no one argues with the market. We act. If the price hits the stop, the trade is closed. End of story. Then we review, not to complain, but to learn. I remember one Monday morning vividly, right after a chaotic weekend full of breaking news. A young colleague with only 2 years of experience was shorting Tesla stock. Unexpected headlines hit, and the stock gapped up at the open. His position was instantly in the red. Instead of accepting a 2% loss, he turned off his stop loss, hoping the price would pull back. 10 minutes later, he was down 10%. 30 minutes later, the fund liquidated his account to prevent a disaster. As he walked out of the room, he muttered in despair, "I just didn't believe it could rise that fast." But the market doesn't care what you believe. It only reacts. To truly survive long-term as a trader, you must train your mind until cutting losses no longer stirs emotion. It has to become mechanical, as natural as breathing. Once you cross that psychological barrier, you realize that trading is no longer a battle against the market, but a battle against yourself. And only when you conquer yourself can your profits grow freely. Those who have survived 2 decades in this business share one philosophy. Small losses don't kill you, big egos do. Every time you hold on to a losing trade, you're protecting your ego, not your account. Every time you cut a loss, you're protecting your future. And here lies the most beautiful paradox of trading. When you stop fearing loss, you start making money. When you stop trying to control the market, you finally gain control over yourself. That's when you ascend to a higher level, where every small loss becomes a stepping stone toward a much greater victory. Now it is time to enter the battlefield, the realm of real trading tactics, where every principle, every philosophy, and every ounce of psychological discipline you have built converges into the edge of a true professional. This is no longer about abstract theories of risk management or emotional control. It is about concrete execution, how to identify, enter, and manage those rare trades that belong to the top 20% of big wins, the ones that generate the entirety of your account's profits. The market does not reward hard work. It rewards those who know how to choose the right battles to fight and win. Every click of your mouse must carry that mindset. The mindset of a Wall Street veteran who has survived 2 decades of market chaos, knowing that real opportunities appear only a few times a year. And when they do, you must be ready to act without hesitation. Seasoned professionals never enter a position based on feelings or news headlines. They search for the consensus zone, the point where the strongest technical elements converge, forming what we call the intersection of conviction on the chart. A consensus zone is not just a support or resistance line. It is the area where both buyers and sellers concentrate their energy, and the moment one side gives up, price moves with explosive force. That is where probability tilts in your favor. For example, when a stock like Tesla reaches $200, a level tested 3 times over the past 6 months, while the 200-day moving average sits near 205, you are witnessing a market structure that is far from random. At that level, crowd psychology, institutional algorithms, and technical signals all whisper the same message. This is where the game can reverse. When you act there, you are not just trading a signal, you are betting on human behavior, the only constant in financial markets. Once the consensus zone is identified, professionals never enter with vague risk. The small loss must be placed precisely outside the zone, the point where your idea is officially wrong. If support is at 200, the stop loss must sit at 199 or slightly below, never further. An undisciplined trader will move the stop lower when price moves against them, telling themselves, it will come back. But the professional knows that every time you move your stop loss, you lose a piece of control over yourself. In contrast, the big win target is set at the next consensus zone, where the market is likely to face the next barrier. That is how every trade transforms from an emotional gamble into a structured strategy. Imagine buying Tesla at 206 with a stop loss at 200 and a profit target at 224. You risk $6 to make 18, a risk-reward ratio of 1 to 3. You don't need to win often. You only need to be right 3 times out of 10. If those 3 trades hit their targets and the 7 losers are small, you still come out ahead in a big way. That is the essence of the 80-20 rule in trading. Most of the time, you will be wrong. But when you are right, the payoff more than compensates for all previous mistakes. And that only happens when you follow your rules with absolute precision. When the market moves in your favor, this is where position management becomes an art. Amateurs close trades too early out of fear of losing profit, while the reckless hold on too long until their gains vanish. But veterans use scaling in and trailing stops strategically to turn small opportunities into true big wins. When a trade moves into profit and breaks even, instead of closing it, the pro adds to the position, but never with new capital. They use their existing profits as risk for the new entry. This transforms the entire trade into a risk-free game. Even if the market reverses, they still protect the original gain. If price continues trending, they double or even triple their reward. On Wall Street, we call that playing with the house's money, trading with the casino's chips, not your own. To control risk once the trade is running, a trailing stop based on market structure is indispensable. Instead of using a fixed distance, say 50 pips, professionals track recent highs and lows, the swing points that reflect the market's heartbeat. When price forms higher highs and higher lows, they move the stop just below the most recent low. This way, if the trend remains intact, the trade stays alive. But when structure breaks, they exit instantly, locking in profit. This is not just about capital protection. It is about letting the market tell its own story. Skilled traders don't try to predict how far price will go. They simply ride the trend until it stops. To visualize this, think back to NVIDIA's historic breakout after its 2023 earnings report. While the crowd took quick profits after a 20% jump, professional fund managers held their positions, moving stops along weekly swing lows, allowing the trade to run more than 80% before being stopped naturally. That single trade outweighed dozens of smaller ones. Not because they knew what would happen, but because they refused to interfere with active profit. They didn't stare at the chart every 10 minutes, nor panic over minor pullbacks, because they understood that big wins belong only to those patient enough not to touch a winning trade. Another crucial element is selectivity. Beginners chase setups every day, constantly looking for trades. Professionals, on the other hand, wait for trades to find them. They may skip 9 opportunities just to take one high probability setup. That is not laziness. It is strategic discipline. Most of the big wins in the careers of Wall Street traders come from clear consensus zones where technical and psychological forces intersect, such as a support zone after a major shakeout or a resistance zone after a false breakout. These areas are not just technical, they reveal the footprints of smart money. Picture yourself watching the gold chart, XAUSD. After a strong rally, price suddenly drops to 1,980, a former peak now turned into support. Many traders panic and sell, but a professional recognizes this as a belief test zone. A bullish pin bar forms, volume spikes sharply, and the long-term trend structure remains intact. That's when they enter, with a tight stop just below 1,978 and a target at 2,015, the next resistance. The risk is $12. The potential reward exceeds $30. That's not magic. It's the art of choosing the right battlefield. The beauty of focusing on the top 20% of setups is that it naturally reduces trade frequency, lowers emotional volatility, and sharpens decision quality. You no longer trade to feel in control. You trade like a strategist who acts only when all signals align. And it's precisely this scarcity of action that gives you power. The market rewards those who wait, not those who chase. Ultimately, the greatest secret behind the small loss, big win strategy lies in its repeatability. Everything can be quantified and refined, from selecting consensus zones to setting stop losses, scaling in, and trailing stops. Professionals never rely on intuition. They maintain detailed trading journals where every decision is measured. Over time, they discover that as long as they stay loyal to the process, results will follow naturally. Markets change daily, but human behavior never does. And that is the true path of the top 20% big wins. Choose the right consensus zones, accept small losses, stay patient as profits grow, and never break discipline. When you do this, trading stops being a game of chance. It becomes a business where every decision has value, every mistake is controlled, and every major victory is nurtured to its fullest. This is the essence of true Wall Street thinking. Don't chase profits. Let profits chase you. Turn trading into a business. When you have reached this stage, you are no longer a gambler chasing a lucky hit. You have become the operator of a financial machine where every trade, every decision, every click to buy or sell is executed with purpose. You understand risk management, psychological control, timing, and how to nurture a big win. But to move from being a systematic trader to building a true trading business, you must go one level deeper, transforming your entire trading operation into a structure that can be measured, optimized, and scaled, just like an investment fund or a financial firm. Because at the highest level, trading is not an emotional game. It is a game of data, discipline, and continuous evolution. Imagine your trading account as a company, and you are the CEO. Every trade you take is an investment. Every loss is an operating expense. Every profit is revenue. And like any real business, if you do not track your metrics, analyze your reports, or refine your processes, that company will go bankrupt. This is exactly the stage where amateurs stop and professionals begin to grow. In-depth analysis, identifying and amplifying the 20% that drives 80% of results. A seasoned trader never looks at overall profit alone. They dissect every detail and break down every piece of data to find which 20% of actions generate 80% of results. In a professional trading journal, every trade includes key information: entry time, exit time frame, market condition, price pattern, emotional state, and exit reason. Over time, these numbers become more than dry data. They turn into a mirror reflecting your true trading identity. For example, after 6 months of trading, you may discover that 80% of your profits come from trades taken during the European session, from 2 to 5 p.m. Vietnam time, mostly on the EUR USD pair. Meanwhile, trades placed in the Asian session or just before the US Open often end as small losses or break-even results. This is the treasure your trading journal offers. It not only tells you what you did wrong, but also reveals what you are doing right. And your job is to amplify that advantage tenfold. An experienced trader will immediately take action, cutting out 80% of unproductive trading hours and focusing solely on the 20% golden window. By doing so, they save energy, reduce emotional swings, and raise their profit per hour to a level that even hedge funds envy. That is the essence of the 80-20 rule in trading. You do not need to do more. You just need to do what truly matters. Another crucial aspect of performance analysis is comparing your actual risk-reward ratio, actual RR, to your planned risk-reward ratio, planned RR. If you always set a target of 3 to 1, but your average exits only reach 1.5 to 1, that is not a strategy issue. It is a psychological one. The fear of losing profits makes you cut winners early, turning potential big wins into meaningless small wins. Recording and comparing these numbers forces you to face reality. Are you truly following your trailing stop discipline? Are you really letting your profits run as you claim? Wall Street professionals never trust the feeling of, "I'm doing well." They only trust data. Optimizing the stop-loss mechanism. Learning from small losses. Beginners see small losses as failure. Those who have survived 20 years in the market see them as raw material for evolution. Every small loss is a data point showing where the market disagreed with you. And when you learn to read that data, you turn mistakes into assets. Take a real example. After reviewing your last 10 losing trades, you realize that 7 of them hit stop loss just minutes before the price reversed in your favor. That means you are placing stops too tight, getting shaken out by short-term noise rather than being wrong about the trend. The solution is not to change your strategy, but to refine your risk buffer. You could widen your stop by 5 pips or use tools like ATR, average true range, to determine a safer buffer. The goal is not to avoid losses, but to ensure small losses are statistically meaningful, happening only when your trading idea is genuinely invalid, not because of random volatility. At a higher level, quantitative hedge funds even categorize small losses by pattern. They know exactly which candlestick formation, time of day, or macro condition tends to produce failure. When a losing pattern repeats too often, they eliminate it from the system. When a winning pattern appears, they increase its weight. You can do the same, as long as you have enough data and discipline to avoid reacting emotionally. In the eyes of a professional, small losses are equivalent to R&D costs in a company. They are necessary expenses to discover a truly profitable product, your trading strategy. And like any successful business, you do not cut those costs blindly. You optimize them. Building a sustainable framework, a business plan for trading. A successful trader never trades randomly. They operate under a business plan, a detailed framework built around 5 elements: capital, expected return, performance review, and psychology. First, capital management. No business invests all its funds in one venture. Likewise, a professional trader risks no more than 2% per trade. This ensures that even if 80% of trades fail, there is still enough capital to survive and wait for the 20% golden opportunities. Second, discipline in risk-reward. A professional trader never targets less than 3 to 1. Just one big win at that ratio can cover 3 consecutive losses. Maintaining this ratio means you are operating under a statistical edge, the same principle that gives casinos a few percentage points of advantage over players. Third, psychology, and discipline. A skilled trader does not need to win every trade, but they must be brutally honest in their trading journal. Every week, they review all decisions, note their emotions, and compare them with their original plan. That is how they eliminate the 20% of bad habits that cause 80% of recurring mistakes. Fourth, periodic performance evaluation. Each month, they analyze where the largest profits came from, identifying which market condition, timeframe, pattern, or asset produced the best results. Then, they increase focus on those opportunities and reduce or eliminate the rest. Finally, continuous evolution. The market is ever changing, so your system must adapt. A strategy that worked in 2023 might no longer fit in 2025. Therefore, professional traders constantly backtest and forward test to keep their tactics up to date. In quantitative trading firms on Wall Street, every strategy is treated like a product. When a product stops generating returns, they pause, analyze, improve, or replace it. You, as the CEO of your own account, must do the same. Turning trading into a true business. Remember, trading is not just a profession. It is a business model with cash flow, expenses, profits, and periodic reports. You cannot control the outcome of every trade, but you can control your process. That is the difference between a gambler and a financial entrepreneur. An entrepreneur does not ask, how much will I win today? But rather, what is my average return per dollar risked? An entrepreneur does not fear costs. They fear costs that yield no valuable data. An entrepreneur is not excited by a single day's big profit. They celebrate when their system runs smoothly for 3 consecutive months. Small loss, big win. At this stage, it is no longer a strategy, but a culture. You become emotionally neutral towards small losses because you understand they are the cost of keeping your business alive. You stay ruthlessly patient with big winners because you know they represent sustainable profits. You are no longer a player against the market. You are the operator of your own trading machine. Picture yourself sitting in the office of a hedge fund in Manhattan. In front of you are screens filled with hundreds of numbers, yet you are no longer overwhelmed. You look at performance charts by hour, by pattern, by asset, and you know exactly where real value is created. At that point, trading ceases to be a game of luck and becomes a series of systematic decisions, a smoothly running business. And when you reach that state, you will understand why only 20% of traders make money. It is not because they are smarter, but because they treat trading like a business, while the rest still treat it like a gamble. So the final question is, are you ready to become the CEO of your own account, to turn every trade into a cog in a sustainable profit machine? Or will you continue to let emotions dictate your decisions? That choice will define your entire financial future. You do not need to chase wins every day. What you need is one strong hit in a month and a few big hits in a quarter. The market does not reward impatience. It rewards those who are patient enough to wait for moments when probability tilts in their favor. That is the essence of this game. You cannot control the outcome of each trade, but you can absolutely control how you react, how you protect your capital, and how you allow your profits to grow. New traders often believe that trading more means earning more. But the reality on Wall Street is the opposite. The fewer the trades, the better, as long as they are taken at the right moments. Warren Buffett once said that the market is designed to transfer money from the impatient to the patient. And in trading, that truth is brutally accurate. Do not be obsessed with being right. Be obsessed with protecting your capital and maximizing opportunity. A professional on the trading floor does not measure their worth by how many trades they win, but by their ability to survive hundreds of small losses. Each small loss is simply an operating expense of your trading business. Treat it as the cost of admission, the fee that allows you to stay in the game. Just like any major corporation, there are operational expenses, staffing costs, and risk expenses. But they stay in business because they understand those costs are necessary to get closer to profit. Once you shift your perspective, small losses stop being frightening. Small losses will not make you poor, but failing to cut losses in time will make you go broke. Remember this. Amateur traders hold on to losing positions, hoping to turn losses into break-even. Professional traders cut losses to protect their ability to participate in the next big win. I once witnessed a young trader on the New York floor who turned $50,000 into $200,000 in just 3 weeks thanks to one big win on Nvidia stock. But what made him truly professional was not that winning trade. It was how he survived 12 consecutive small losses before that without losing focus or confidence. He understood one simple truth: every small loss is the ticket that gives me the chance to meet my big win. That mindset is what builds long term consistency. Thank you for listening. Start operating your trading machine today with the discipline and mindset of a Wall Street professional. Trading is not luck, it is precision, discipline, and the ability to see beyond the crowd. If these insights help you expand your perspective and you want to continue strengthening your trading mindset, subscribe to Trading Mindset Lab. Here, we do not just talk about strategy, we help you build mental steel, the weapon every great trader possesses. Do not trade with just skill, trade with awareness. Let us walk with you on your journey to becoming one of the 20% of traders who survive and thrive in this ruthless financial market.